All right. Hello, Zach. Welcome, man. We're going to do a video today just talking about airline pilots, professional pilots, side gigs, how to successfully take the income from your side gig and defer it from taxes legally, smartly, right? So
Right.
that's what we're going to cover today, Zach, because it's interesting, man. You just joined us a few months ago here at Leading Edge, and you're a certified financial planner. You've been in the business a while. But when you started working with us and some of our airline pilot clients, you're like, man, all these guys and gals have side gigs.
Yeah, it
So
really surprised me. There's a good number of them.
that's right. So I was like, that's a good point. And we talk about this a lot, but sometimes I didn't think about just getting this message out to where, we're going to talk about today the solo 401k. There's multiple ways to take advantage of that side gig income. In fact, Zach, a lot of people start a side gig, sounds silly, to actually have a tax deduction. And
Right.
so that's cool. Sometimes there's a tax deduction, that's a whole nother podcast or a video. But in this case, we're going to cover couple case studies where people start side gigs and they start making money. In fact, one of our best examples is a good friend of ours, Southwest Airlines pilot Jack Stewart is an author, great dude. Check out one of our Pilot Money Guys podcasts. He's on there, but he's done really well with his book writing. And so that might be an example. We have other examples. It seems like at every airline, Zach, there's some of these pilots have some really good ideas and start doing some really amazing things. One guy we know, he started on Etsy making what is it, lamps out of bourbon bottles.
Bourbon lamps. Yeah.
It's amazing, man. And so it's in fact, go check it out on Etsy. It's Nash, as in Nashville, Nash, bourbon LGTS, as in Nash Bourbon Lights. Go to Etsy, check it out. John is another pilot that is, again, just loves to do it. He does a great job. So we see these opportunities, Zach, where, hey, they start making some income and we go, all right, let's learn how to shelter this income from taxes, defer it from taxes. And an individual 401k is a great tool for that. With all that being said, the context, the purpose, I got with you and said, hey, let's go through this and talk about this solo 401k, the pros and cons. Can you give us just an overview
Yeah,
of the solo
absolutely.
401k?
Yeah, and I think it's a cool strategy too, because not a lot of people know about this. It's called a solo 401k, but you'll hear us refer to today as a solo K. It's a 401k basically designed for self-employed individual, side gig type of business, you know, outside of the realm of your normal 401k. And I think it's not often used because I think a lot of the clients that we work with and a lot of the people we talk to, they're maxing out their 401ks. They're topped out from employer contributions, employee contributions, and then they think, well, I'll have to wait till next year to start saving again. But in reality, for people that fit this category of you have a side business, a side gig, there is this cool strategy with the solo K where you can start to shield a lot of dollars from taxation, potentially.
Mhm.
And most importantly, like Charlie mentioned, legally.
That's right.
So I'm going to share my screen here
Yeah.
and walk you all through an example.
Yeah. And while you're sharing, Zach, while that's coming up, I mean, I've talked about pilots starting side gigs, but a lot of times our spouses, let's say it's a pilot, airline pilot, the spouse, maybe they're a fitness instructor, or maybe they do something earning 15, 20, 30, 40,000 a year. They're also really good candidates if they're self-employed for this strategy as well. So go ahead, Zach.
Yeah, important caveat there is that you can't have an employee outside of the household. So let's say you, Charlie, had, a side gig and your only employee was technically your spouse. Well, that still will work for this, but you
Mhm.
can't have, multiple different employees that work under you. That would be a separate retirement plan that we could talk about further. But
Yeah,
for the
absolutely.
sake of the 401k, I've laid out this example here. So we have an airline pilot who's age 55 who contributes the max amount to their 401k each year through the airline. So they have contributed the most as the employee. The employer has added all they can, and they're kind of maxed out for the year. Also, outside of the airline, this client has a side business where they employ their spouse and they pay their spouse $50,000 a year, and they pay themselves $50,000 a year. So imagine this total compensation $100,000, 50 to one spouse, 50 to the other. with that, first I've laid out what it looks like just from the original airline 401k.
Mhm.
Exclude everything we've told you at solo case so far. So with the original airline 401k, you as the employee, in 2026 have contributed $24,500. And then, because you're over the age of 50, you're actually contributing an additional 8,000, which brings the total here to 32,500. Your employer at the airline will contribute 47,500 because it will get you to that limit, the total limit that you and the employer can add on an annual basis. The total for both of those with the airline 401k is for 2026, you and your employer have saved $80,000 in the retirement plan. So now, with this side gig considered here, let's say we set up a solo 401k, and now your spouse, because they work for this business, and let's just assume also that they're the same age as you, so 55, they contribute for 24,500 as the employee. Then with the solo K, because it's so similar to the 401k, you still have access to this catch-up Roth or catch-up contribution.
Mhm.
So that brings the spouse as the employee total contribution $32,500 for 2026. Now here's where it gets a little tricky is with the airline 401k, your employer, depending on the match or the non-elective contribution, they can just add money up to whatever that top limit is in a given year. But with a solo K, this is where it differs a little bit from the normal 401k.
Mhm.
You're actually limited as the employer to contribute 25% of the compensation per employee here. So for the spouse, the most compensation that could be added on behalf of your spouse is $12,500, which is 25% of 50,000.
Mhm.
Even though you have already contributed the max amount that you can to your airline 401k for 2026, you as the employer in this side gig can still contribute up to 25% of your side gig compensation,
Mhm.
which would be the same as your spouse's here, 12,500, because in this example, you all make the same amount of money. So this has brought on another $25,000 of savings, potentially getting tax deferred that you're not having to recognize this year, which would bring the total additional savings from the solo K to $57,500 per year. So this means originally you were saving about $80,000 a year in the 401k. With the solo K strategy, you're actually closer to up to about $137,500 per year. Assuming all of this is pre-tax, we can talk further about the pre-tax versus raw stuff if you
Mhm.
like. This is a significant amount of money that you can defer, tax-wise, and then just withdraw and pay the taxes later on when you're in retirement, potentially in a lower tax bracket.
Mhm. Yeah, it's awesome, Zach, because the context of our discussion is, hey, I'm making money on my side gig. I meant to have a tax deduction, and now I'm making money. I'm paying more tax. Or a spouse that says, hey, all of my $30,000 that I get from being an instructor is taxed at this highest marginal tax rate. So the context of our discussion today is deferring that tax. However, like you just noted, some of this could be Roth in here for your spouse, which is incredible. We love Roth, depending on the tax situation and all that good stuff. The other thing that is possible, now you nailed it earlier, Zach. This stuff gets a little tricky. You're going to want to, use your tax professional business, bookkeeper slash accountant to help you keep these numbers straight. But you could also do after tax contributions here above some of the normal limits that we talked to. This limit here, if you're getting the catch-up contribution, is 32,500. That's called the 402G limit. But again, depending on the income, depending on the scenario, you may be able to do after tax contributions above and beyond that, which could then be converted to Roth. Again, that's a little bit more complex, not necessarily fit in with the numbers here that we're showing, but it is a possible thing. The other thing, Zach, is a person could borrow from their 401k as well. So really flexible. Like I said, like you said, you nailed it. A little bit on the complex side, but don't let that complexity scare you. Refer to your tax professional advisor. We help with these things And it can be done to save quite a bit of tax and help you to better prepare for your retirement as well.
Yeah, with the pre-tax versus Roth options here, I think those are the two main reasons I see people set these up. The
Mhm.
first would be to shield more money from taxation and defer it out to retirement, basically. That was kind of the example I laid out here, where I'm just assuming everything is pre-tax. These clients are potentially in their higher income years. Maybe pre-tax makes more sense for this situation. But let's say that, we remove the age 55, and this is a young couple who they have a side gig that's really taken off and it's making them a lot of money outside of the airline. The Roth option would really make a
Yeah.
lot of sense because as the longer you can keep dollars in Roth, the more you can get that tax-free growth,
Hmm.
in that case over decades, which really compounds for these clients in the long run. So I think those are just the two main reasons people go to these. One being additional tax deferral,
Hmm.
two being the ability to really shovel away more money into a Roth bucket.
Yeah. Yeah, it's incredible. And I'll just summarize here before we wrap up because it's important to think when you're at an airline, there's you, the airline pilot or the professional pilot, corporate, wherever you're at, and then there's the employer. When
Right.
you are working for yourself, you are both essentially. Now, you still have to keep that delineation going because the 32,000 that we talked about, Zach, and I said this is the 402G limit. Each person only gets one 402G limit, regardless of how many side gigs they have. But you do have the option, as long as the employers are not related, as long as it's not you owning five different companies, if they're completely unrelated companies like an airline and this business would be, then you do have more than one essentially employer contribution. So that's where this comes in handy, and that's kind of what you've talked about before. I just wanted to summarize that because that's really the basis, the foundation of this strategy that allows it to work.
Yeah, I think just to add to that as an example, if the case here were you only added $10,000 to your 401k in 2026, because these work against each other, the limit counts as one limit, no matter how many 401ks you have. That would mean you as the employee over here could add 14,500.
Mhm.
So they
Absolutely.
they they have to sum together to hit these maximum amounts year to year.
Excellent.
Yeah.
Zach, anything else before we wrap up?
No, I think it's a cool strategy that could be very applicable to some of the people we talk to and work with, depending on how their side gig is going. If
Hmm.
this one doesn't quite fit with the business model or income that your potential side gig has, I think there are still some other cool strategies out there that we'd be happy to help with.
Yeah, absolutely. Thanks for putting that together, Zach. Just remember, this is not tax advice. It's very tricky, a lot of nuanced things here depending on your business. Seek professional help when doing these things, and so it's worth it though, right? Either dig in yourself and figure it out, or seek help professionally because it can be worth it if you're in this situation. But give us a call, email at Leading Edge Financial Planning. We're happy to help. LeadingEdgePlanning.com is our website. You can call our office number and get any one of us and chat. We're happy to answer any questions. Our number is 865-240-2292. Zach, thanks so much, man. I appreciate your time today.
Yeah, thanks for having me.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.